Financial advisors are cheap. Click on the link below for free research.
All right, welcome back, everybody, to another episode of Who Charted, brought to you by the team at Research by Potomac. Director of Research, Dan Russo here. With me, as always, is Drew Wells, who has wasted no time transitioning into the fall gear, breaking out the Midtown uniform, as well as the flannel. All right, let's get after it. 6 charts, 6 minutes. Drew, kick us off.
All right, this is one that you've seen us show in the past. This is the percentage of S&P 500 components that are highly correlated with the index. Okay, so a couple things I want to note on this chart here. Crossing above that 50% mark in Friday's trading session right there as the equity markets, as the S&P 500 continues to sell off. This usually can be an indication that some type of bottoming process is, kind of starting to form. I don't want you to hear me the wrong way. I'm not saying that this is the bottoming process, right? So we could see kind of some intermediate term chop, I think, around here, around these levels. This 50% mark, by the way, is not necessarily anything extreme. We saw 80% plus numbers during the depths of the COVID crash. So we're not anywhere near extreme, what would be considered extreme levels yet. But if you're an active investor, or if you pay attention to your differentiation compared to the benchmark, just note that right now more components are moving more closely with the index. You should probably spend quite a bit of time paying attention to the price action at the index level.
All right, speaking of the benchmark, we continue to believe that you could get some alpha, if you will, by focusing on commodities. Yes, commodities have moved into a consolidation. However, the Bloomberg Commodity Index still trades above its 50-day and 200-day moving averages with a clear zone of support between, call it 106 and 110. I think as long as price is above the 106 to 110 zone, right, you have to give the benefit of the doubt to the commodity bulls. At the same time, relative to the S&P 500, so commodities versus stocks, for all intents and purposes, has staged a nice rebound here over the past couple of weeks, trading above its 50-day moving average, trading above a rising 200-day moving average. So if we just think in terms of asset allocation, we still think it makes sense to have a focus here on what's happening in the commodities market. I still think they're under-owned. I think some late chasers back in the June timeframe maybe got caught and shaken out, but opportunity there nonetheless.
All right, for those of you who must remain invested, relative strength is one of your friends, right? So this is frontier markets. If you have to have an international allocation, many accounts do, particularly long-term strategic asset allocations, have to have some type of international allocation, right? So basically you're looking for pockets of the international space. We've been talking about this for really almost a year now, that are performing less bad. Take a look at frontier markets here. I'll get to the absolute chart here in a minute, but I want you to focus on this relative price action at the bottom pane there, breaking out of a kind of long-term relative resistance zone above the 50-day moving average of the ratio. It's some nice price action. It kind of flies in the face of some of the risk-off behavior that you're seeing out there. And I think it's important to remember that markets are a discounting mechanism. I don't know if this is the bottom, but it's nice to see that some bottoming action is kind of occurring out of this risky area of the market.
All right, let's talk about breadth here on the New York Stock Exchange, in particular 52-week and 6-month lows. Now, a couple of weeks ago, the people who got really bulled up on equities were pitching that new lows were non-existent. And they were right. 5-day moving average of both of those metrics kind of ticked below 2%. However, over the past couple of weeks, call it a week and a half of trading, we have seen new lows start to pick up again. All right, starting to move to the top side. Now, nowhere near the tops that we saw in May and June, fine. However, what we want to see here as equities are under pressure, if the June lows are tested for the S&P 500, we want to see these two metrics make lower highs relative to June. That would be a positive divergence. And obviously, you want to see the June lows in price hold. However, if we break the June lows in price with these metrics making new highs, getting up above kind of the mid-20s, I think you'd have to brace for more downside. So a big part of the bull case is getting kicked out as we speak.
All right, I'm going to continue on this theme of finding what's been working if you have to remain invested, particularly in the bond market, right? We've seen a nice precipitous rise in interest rates, as you've all known, over the past couple of weeks or so. And if you have to remain invested in the bond market, you know that owning the ag or the BND, ETFs out there that carry quite a bit of duration risk in them have really hurt you so far this year. So the question is, how do you position accordingly and try to find areas of the market that are really just losing less? And I think this is a great example of that. This is 1 to 3 year treasuries here. Obviously, it's probably one of the most conservative areas of the bond market right there, breaking above that relative resistance zone. Again, recapturing that 50-day moving average to the upside. So again, it's much more conservative in the bond market right now. It's much less focused on duration. Momentum in the bottom pane there, really kind of recapturing that bullish zone, the top end of that bullish regime. Haven't seen an overbought print yet, but it's one to keep an eye on.
All right, I'm going to wrap it up here with 2 charts that I think are interesting in this market. The top panel is utilities. The bottom panel is comm services. Comm services, obviously the sexy, right? That's where Google, Facebook, Netflix all hang out. Utilities are boring. However, take a look at the charts here. Since the COVID lows, utilities have done a steady grind to the upside and are actually trading near all-time highs. Now, after a sharp rally, comm services have rolled over. They've been in a downtrend all year. If you've been reading our work, we've been dumping all over this sector within our sector work for a long time. But what's interesting to me, the numbers in the charts, you're probably asking yourself, what are those numbers in the charts? Well, I'm going to tell you what they are. They are the respective weights within the S&P 500. Utilities, 3.16%, according to data from Y charts, and comm services, 8.41%. So if you choose to just buy the index, you are making a conscious effort and a conscious decision to overweight the bottom chart relative to the top chart within your equity allocation. And that just, we struggle with that, which is why we do sector work, which is why we focus so much on relative strength. I realize I'm probably going over time, but every now and then I'm entitled to a rant. This is my rant. You are choosing to overweight the chart that is heading lower, the bearish chart, the downtrend, while choosing to underweight relative to each other the chart that's heading higher. Utilities versus comms has been one of the biggest stories all year. We've been talking about it in our sector work. If you just own the index, you own more of that bottom chart than you do the top. That's where I stand this week.
Thank you all so much for spending some time with us. If you like this content, don't forget to like and subscribe on the channel, and we'll see you in the next video.
We'll see you soon.